James, very good afternoon. James, the Rand trading around 683 this afternoon, and that's after hitting 675 in yesterday's session. And a very positive response across all markets, really, to that quantitative easing package out of the United States on Wednesday.
That's right. Good afternoon, Stephen. Exactly that. Quantitative easing pretty well received by the market and reflected in all the asset classes. Equities looking good, bond purchases across the globe looking good as a result. But now, what's next? Obviously, we're looking at non-farm payrolls today, and such an important figure. It seems to be, not as important because we've had such a big week of information. But it really is, it's a good number to be looking at. And I think we're seeing a little bit of retracement in all the markets, especially the currencies. Just the dollar, recovering a little bit, and obviously looking towards those numbers this afternoon for the next direction.
Of course, the market is expecting jobs to have been created during the month of October, and I think 60,000 jobs is the number that's being thrown around at the moment. If we miss the mark on that, do you think we could see further dollar strength or weakness?
Yeah, I mean, that's it. I think, more importantly than anything else is the level of unemployment in the States at the moment. But, breaking it down, looking at the non-farms, if it comes in negative or even at zero with no jobs being created, that won't be taken very well at all by the market. But, longer term, we need to see that level of unemployment come down. Sitting around 9.6, anywhere between 9.5% and 10% is really negative. We need to see job creation. And just looking at the data that's come out this week, we've seen some sort of not very encouraging employment numbers yesterday. And also just looking at the productivity levels, productivity up. Well, that's not necessarily as a result of increased productivity, but just the way it's being measured with obviously lower levels of employment per capita, it's looking better. But what that does indicate is that companies aren't employing with the same sort of productivity levels. They don't have the confidence to employ more people at this point. So that is the concern.
Just looking at the bond markets and how they've performed this week, because I know that we had South African yields falling to record lows yesterday. Is that the trend that we've seen globally? Have we seen those bond yields continuing to come down?
Yep, as a result of extra liquidity in the market, naturally all the bonds have rallied as a result. In the American market, we've seen those 10-year bonds coming down. Funnily enough, the 30-year bond going higher in yield terms, but that is a result of where the quantitative easing liquidity will be used, and that's pretty much from the 5 to 10-year area of the American curve. Looking locally at our own bonds, that's right. From the start of October, we've rallied around 50 basis points lower. So that's an indication of two things: appetite for the higher yields that we're offering as an emerging market, and also the view on interest rates as it's developed over the last month.
What is the view on interest rates at this point, James?
I think it's for a greater chance of a cut really at the moment. Just looking at the rhetoric coming from international central banks, low rates for long, more quantitative easing. Will there be more going forward? I think as far as the international economy is concerned, big concerns about deflation. So I think, that is certainly on the minds of the South African authorities, and the chance is increasing definitely for a cut in our interest rate cycle.
Because we have had Reserve Bank Governor Jill Marcus saying that rates are at appropriate levels unless things change. Have things changed with that QE2 package?
Well, not necessarily as a result totally of the QE package, but what she certainly is referring to when she says unless things change is inflation expectations. And how is that, what is going to contribute to that? The level of the Rand, the strength of the Rand. And since she made those statements, certainly the Rand has strengthened and looks to strengthen as a result of quantitative easing, as you say. So I think inflation expectations definitely have changed. And we've seen surprises constantly in that inflation, with CPI coming in at 3.2, just narrowly above the lower end of that range. Those are things that will be considered, certainly.
Do you think we could get more than one interest rate cut at this stage, James? Because initially the thinking was we might get one in February and not in November. Do you think we could get both of those meetings a cut?
That sort of, the market will price that if we get a cut in November. But ultimately, those sort of decisions will be data reliant. So as we see the inflation picture develop, so the market will start looking for more or less cuts. And at the moment, we really are sort of on a knife's edge with inflation, just as I say, at the lower end of that range. If it starts breaking lower, if the currency continues to strengthen, then definitely, you know, the market could look for more cuts. But I think before, you know, at the moment, the interest rate curve is is fully discounting a 50 basis point cut spread sort of between November and the beginning of next year. But, you know, if we don't get a cut in November, the curve will react accordingly. And if we do, then I certainly think it will start definitely discounting further cuts in the cycle.
Golden Forex data out this morning, net reserves up by about $2.2 billion. So that's looking pretty positive.
Yeah, it's rand positive as well. Our import cover up to 6.4 months, which, you know, that's a fairly good supportive level. The reserves up obviously as a result of stronger gold, but also the data flows that were absorbed by the Reserve Bank. So yeah, some pretty rand positive news this morning too.
James, internationally, it looks like Europe's back on the radar as well. Ireland and Greece looking closer to default, and really the focus has been on the US Fed and what's happening in the United States, but it looks like stuff is still happening in Europe at this time.
That's right, Stephen. I mean, in such a big week with regards to the American economy, Europe has slipped off the radar. But if you know, it's certainly if you look at the spreads of Greek debt and Irish debt over the sort of benchmark German bonds, they're at all-time high levels, and certainly levels that the market is effectively pricing in a good chance of default there. So, yeah, I mean, Europe is still not in a good space at this point, and that has its impact onto the South African economy as well, with Europe being a big export destination for us. If their economy is battling over there, it will ultimately feed through to our own. So it is a concern, certainly.
And do you think that's another factor that the Reserve Bank will be looking at when it makes that interest rate decision in just under 2 weeks' time?
Yeah, they're going to look at all things that these international central bankers have been saying. There's concerns, as I've said, about deflation. There's concerns about the economy. And the main point being interest rates are going to be at a low level for the foreseeable future, if not longer than has been previously stated. So that definitely will influence our own Reserve Bank in 2 weeks' time.
And just finally, looking at those non-farm payroll numbers this evening, 60,000 was the number I think we were talking about. You said if we miss the mark on that, we could see further dollar weakness, but otherwise we could see the dollar strengthening. Would that be temporary strength, do you think, for the dollar?
I think so, yeah. With the quantitative easing, you know, pleasing the market and is going to be spread over the next 12 months, I think any sort of retracement would be short-lived given the sort of structural effects that this quantitative easing will have on the dollar. So, yeah, it's going to have a reaction either way, but I think longer term we have to go with the trend as it's been established for a weaker dollar.